Welcome to episode 10 of the More Doors podcast. Today, we are talking about potential expense relief, Class A rents versus Class B, and just where the state of the market kind of is right now. We've got a lot to cover, and we are going to get started right now. All right, welcome to episode 10 of the More Doors podcast. I am your fill-in announcer, Brian Force, here with Matt Buchalski. Our other partner, Nick, has a sore throat today, but I think he's just making excuses exactly for what Jesse is doing behind the camera right now. We're going to get started, though, but first, we need to talk about our favorite sponsors for the show. That is Deep Blue Capital. Go check out deepbluere.com if you want to start or continue your wealth building journey, building passive income through multifamily investments and commercial investments. Check us out at deepbluere.com. Join our investor list, learn more about what kind of upcoming projects and opportunities we have. Get educated, get into the things that we're doing education-wise, webcasts and all that type of stuff, and the value that we're bringing there as well. And then when you're done with that, make sure you check out Tor Studios. That's TORE Studios.com. And if you want to create your own content, have a really kick-ass podcast like we do as well, come join us here at Tor Studios. We've been running this studio for a few years now, and whether you want to create a professional show or any other type of content, Tor Studios is the place to do it. Boom! Fastest we've ever gotten through sponsors.
Word.
What's going on, buddy?
What's up, man?
Oh, man, it's just another beautiful Thursday out there. 155 degrees outside, but it's nice and cool in here under these bright lights.
True. It's so hot outside that you start to sweat when you think.
Oh, yeah. Like, I went to the gym yesterday in the afternoon. I tried to go in the morning, and I went in the afternoon yesterday, and I normally do like 5 minutes in the sauna before I go, just gets my blood flowing and stuff. Mm-hmm. I got out of the car. By the time I walked from the car to the front door of the gym, I was like, I don't think I need to go to the sauna.
Definitely not.
Like, I would felt like if I got in the sauna after walking out in that high heat, I would be even worse off.
Like I said, you could pretty much just turn the air off in your car while you're driving to the gym, and that's your sauna time.
Pretty much.
True.
Like,
True.
Ugh.
I was just telling you guys before the show, right? I was in the hot tub last night. I had to set it 101. And I got out of the hot tub, and it was the same temperature in the water as it was outside the water. And that was at 10 o'clock at night. It's nuts.
Dude. I don't know if I can. Are you a summertime hot tub guy?
I'm a year-round hot tub guy.
Year-round hot tub
January,
guy? December,
snow, don't care.
Yeah?
I'm in it. Self-care, man. Hashtag self-care.
Hashtag self-care. No, 100. I have a vision for when I get my next home.
Hot tub.
Yeah, but I don't want a pool. I don't know. I'm not a big pool guy. And the maintenance seems like a lot. The pool maintenance. I want but I also don't want an above ground hot tub, like a shell. I want an in-ground hot tub as if it was connected to a pool. But
so you want a bowl with a heater?
Pretty much.
Got it.
I just want the hot tub part, and I don't want the pool. I think that'd be cool. I'd cover it up
for a guy in residential real estate. I don't know if that's going to help your resale ability.
So most of what I want in my home does not lend itself to like the standard like good decision making of my profession at all. No, like
dare I ask what are the other things?
Well, the hot tub would be covered by like some sort of putting green that you hit a button and the putting green opens into a hot tub.
Some kind of James Bond putting green hot tub combo.
It's going to cost a fortune, but how do you value that on resale? Like, it's just, that doesn't make any sense.
That one's not showing up in the appraisal.
No,
Sorry.
It's not. So, like, there's most of, like, my ideas like that probably I'm not going to recoup much of my investment on, but I think home is what you make of it. So I want my place to be awesome. So
go for it, man.
I'll invite you over for a bunch of mini golf, and then we'll go hot tubbing.
I'm into it.
What are we talking about today? I think that one of our investment theses around Class A and the gap between Class A and Class B is maybe starting to show itself a little bit. We talked about, we read an article on, multifamilydive.com, and this was specifically concerning Sunbelt states. I think that, we live in Texas, so is that Sunbelt? It's close enough.
Yeah, I think it's Sunbelt.
Don't we play? Doesn't North Texas, isn't that Sunbelt conference? That's conference That's Sunbelt Conference.
Conference USA.
Conference USA? Yeah.
I want to say UTEP is in the Sunbelt Conference.
Yeah, some Texas schools are in Sunbelt Conference, so we made it. And this is essentially talking about Class A rents starting to stagnate, potentially even starting to shrink a little bit, and Class B rents outpacing as far as rent growth. And that has been one of our investment theses for a long time, is like we tend to look at new units or new inventory on the ground as a leading indicator of demand a lot of times, right? Like they're going to build X amount of new units in this area. That means there's a lot of demand, right? But demand comes in many different forms as far as the class of the asset that you're looking at. The demand for Class A is certainly different than the demand for Class C,
Absolutely,
right?
yeah.
You know, and so you've got to look at it through that lens and go, just because there's a lot of new construction coming, is the demand for that asset class, that level, still going to be there? And what are the implications of all that new inventory for, say, Class B? You're indicating that you feel like the population can absorb more units. Are they going to all be able to afford it? Is Class B, what are the implications for all of those new units for Class B rents? That's been one of the things we've been thinking deeply about, and that's kind of what we form our investment thesis around.
True.
You know, and so it looks like, at least in the Sunbelt states, that's starting to show itself.
Yep.
Class A rents seem to be tapering off, and Class B rents still seem to be on the upward trajectory. And so, as an investor, whether you're an LP or a GP, what do you think, just in your mind, was have an open conversation about this? Like, what does that say to you about the next, let's just say, 12 to 18 months of deals coming up?
I think there's going to be continued interest and demand in B and C class apartments, right? I think there's a couple things economically that you got to think about all this new supply coming up online. Number one is the vast majority of them, right, are these big mid-rise garden-style, big, lots of amenities types of complexes, and they're gorgeous and they're beautiful, but they're really designed with the upper tier of potential tenants in mind, right? And that creates a pretty big pricing gap between Class A and Class B. Yep. And that gap can't be ignored, right? You're talking the difference between someone that can afford a $1,800 a month 2-bedroom and a $3,000 a month 2-bedroom based on income is pretty significant, right? And I think that as those apartments come online, people who live in B class, they have a choice to either move up or stay in that asset class.
I have a thesis around, what we define as Class A is normally it is brand new or higher end.
Yeah,
right?
let's just call it 2000s product.
There you go.
Right.
My thesis around this is, and we looked at a deal recently that I think is still out there that we might come and revisit, which would technically qualify as Class A. I think that where we're going to start to see a lot of gaps in demand. I know this from being a tenant for a very long time of Class A properties, is like whenever you renew, the biggest things that you start to get pushback on or give pushback on as a tenant in high amenity communities, you start to go, am I using all of this stuff?
Yeah.
Because my lifestyle fee keeps going up and my parking fee keeps going up and my, whatever keeps going up. Like, I'm not even necessarily upset about increased rent. I know that this is the way of the world and rents tend to go up. But why is my amenity fee continuing to increase when the amenities are the same, right? All that type of stuff. So my thesis is, are we going to start to see an opportunity for new product with fewer or no amenities, where rents you don't need to be charging $3,000 a month, where these really high-end communities, you can build, let's just call it less than 100 unit communities with no amenities really, except for maybe covered parking, if you want to call that an amenity, and you're charging substantially less than we would have to charge for really high end with a super nice resort style pool, all of the amazing gym that, let's be honest, looks good on the tour, but how often do you go?
Right.
And all of that stuff, is that where when we move into, or we continue to be in a challenging economic time, are tenants going to start to look at where is my amenity stuff going? Where is that expense going? And can I find a nice place that doesn't offer all that for a cheaper rent, because I don't use all that stuff anyway?
Right.
I think that's a big opportunity possibly going forward.
Well, I do think that there are some of those types of communities coming online, right? I mean, we've looked at a couple of build projects recently, and we almost took over one that was 75% of the way done.
Yep.
That technically would have been Class A product,
That's
right?
exactly
But they're
the
30,
project
40
I'm thinking
doors,
of.
right? And there's no amenities.
Yeah.
And I believe that there's no problem filling those up.
And I think that project, it's still out there, it seems like.
Yeah.
One might come back around, but
Yeah.
that's the exact one I was thinking of. And, do we start to see more of that, is the era of the resort style Class A community, is it going to go into a bit of a hiatus for a bit?
I don't think it's going to go into a hiatus. I think there's going to be people that continue to develop those assets, and more power to them. They're great. But I think there's also going to be guys like us that are opportunistic and saying, okay, there's an opportunity for a new product, but it doesn't need to have the dog park and the running track and the six different Nautilus gym and all that sort of stuff. And there's going to be people that want to live in a newer product, right?
I think as an LP, if I'm looking at projects, I think that's some of the common sense stuff I need to ask myself. We do this they do this in high finance a lot, where they talk in very, really like glamorous terms to define things that are relatively simple to understand, to kind of justify why they're so high up and stuff. And we can do this in multifamily sometimes too, is we talk in such, high level sort of thinking strategy and stuff like this, that we almost just forget that a lot of this is just common sense. If I'm an LP and I'm looking at the best place to place my money, and I know that there's tons of Class A development going on, and I also look at, I'm looking at economic factors. I'm looking at the U.S. long-term debt just getting downgraded for the first time since 2011. I'm looking at some probably economic headwinds going forward. If I want to place my money in probably an asset that makes common sense in as far as stabilization goes, do I put my money in the massive development that you need kind of a really, really affluent tenant base and continue to have them re-up, and there's a lot of product like that out there? Or does it make sense for me to put my money in new development that caters to really nice, comfortable living and doesn't offer the amenities that you're normally going to get pushback on, but you're also able to make it more affordable? Affordable housing right now is the number one problem in America to be solved. And if you can solve problems, you can make money. Plain and simple.
Agreed.
And so if I'm just thinking from a common sense strategy, that seems like the problem, that's the way that I would solve that problem.
Agreed.
And I think as an LP, I would be really considering that very seriously.
Goes back to buy box and investing criteria that we talked about a couple of weeks ago, right? There are going to be some investors that are willing to bet on the upper echelon of the tenant base, right? And they're willing to take the risk on economic downturn or economic challenges, but that product looks beautiful and they want to drive by it, and it's huge and it's glorious and it's got Wi-Fi connected everything. And there are going to be some investors that personally, like me, that realize that there is going to be more demand for lower end product, right? Now, whether that's 1990s, early 2000s, or just new stuff without all the bells and whistles, there's going to be more demand for that because of affordability, right? There's a lot of folks in this country, right, that can't take advantage of all the new bells and whistles that are being built into these new complexes, and I follow the demand.
You got to follow the demand, and I think this leads to maybe another aspect of this, that this same article that we were talking about, kind of mentions is operating expenses and things like that as well, right?
Yeah.
There's so much to consider when looking at a deal, and if you believe that your demand is going to be high enough for more affordable housing, and you can make the best product you possibly can while stripping down the amenities to basically the most common sense amenities, right? Mm-hmm. You put up 50 units, all really nice. You have a dog park, covered parking, and you're good.
Yeah.
That's a great affordable product right now. And then, Now you're tapering off your operating expenses. You're tapering off your cost of insurance specifically.
Yep.
It's considerably lower than if you have that resort style pool.
Mm-hmm.
Guarantee you that, right? And the gym that if somebody gets hurt in. Right. So it sounds like operating expenses are starting to taper a little bit already when it comes to things like insurance. Who knows how long that's going to hold? We've been on a really wild ride with insurance as well. Mm-hmm. But as an operator, we're always trying to figure out how to streamline expenses, and if you can create a situation where not only are you creating affordable housing and fewer amenities but lower costs, I think in tandem your ratio of operating expenses tends to decrease as well, because you're insuring a lot of amenities when you're building those really high end product.
Yeah.
So I think that's something to very much consider as well.
Absolutely. And I think we have seen a little bit of expense tapering, right? So, outside of what I do in real estate investing, I actually work for one of the best property managements, or if not the best property management software company out there, and look, it was a recurring theme as we spoke to our customers in Q1 that they weren't doing anything because they were taking property tax hikes on the chin and insurance hikes on the chin, and the interest rate environment had everybody kind of frozen.
Yeah.
And it's very interesting how, as all those property tax appeals have started to come through over the last couple of months, and people realize that it wasn't necessarily the complete doomsday that they were thinking about, and there are some insurers that are actually starting to step up and find cost-effective ways to tackle the insurance issues. That demand for software and modernization is stepping up pretty significantly very quickly.
Yeah.
I do want to go back to something though. There's at least here in DFW, there is a ton of new construction coming up, right? Tons of it. I drive around, we were on George Bush the other day and going down to Garland to look at a project, and just construction everywhere, right? Those complexes, once built, and they're starting to do lease-ups now on many of them, they're going to offer incentives to get people in the door, right? So, and tenants of the world, think about this. If you're going into a new development, you're going to get an incentivized price.
Right.
I would not be surprised for that rent payment to go up $300, $400, $500 a month when it's time to renew 12 months from now. So I think the question you got to ask yourself is not just, can I afford this apartment now, but can I afford this apartment in 1 or 2 years when the incoming supply kind of normalizes and the economy stabilizes? The rent's going to go up. Yeah. And can you keep up with it? Do you want to keep up with it, right?
Yep.
Because if you're going to live in one of those fancy complexes, you might want to have a nice car, right, to put in your reserve parking spot that you're paying $50 a month for, right? And can you sustain both?
Yeah.
Right? Or are you just causing your own churn and getting priced out of your apartment in 1 or 2 years when things stabilize?
I agree, and I think as an operator, you've got to be very cognizant of that as well, right? Because you project your vacancy numbers, in a pretty standardized way, but I think that you've got to be, if you are going to have that type of loss to lease because you're incentivizing so many tenants, you've got to be prepared for pretty high turnover year 2 or year 1, or at the end of year 1 going into year 2, I think. And you've got to really underwrite for that.
Yeah, exactly. So I had a conversation with a big developer of Class A product yesterday. And they have a property that's in due diligence for sale. And vacancy dipped to 86%.
Wow.
I'm sorry, occupancy dipped. I got to stop doing that. Occupancy dipped to 86%. And they're like pulling the fire alarm, right? They got one of the big brokerage in there doing their due diligence. They're like, we got to fill this place up. Let's go run some incentives. Yeah. Right? Great idea. Fill the place up, get some good tenants, run an incentive, right? Maintain the trajectory of the deal. Yep. But they're not the only ones that are in that situation, right? Yeah. And in a competitive market where you need to put butts in beds or heads in beds, you're going to offer an incentive that doesn't last forever.
Well, it is the very basic economic rule of the race to the bottom.
Exactly.
If everybody's seeing the same problem, somebody's going to be willing to go as low as they can possibly go. I mean, you are literally, this is a Mexican standoff.
Yep. And I think, too, we're in a way different environment today than we were 2 years ago. And if you think about the time it takes to get one of these major projects off the ground, in contract, horizontal development, vertical development, different phases of construction, the underwriting for that deal probably happened 2.5 years ago at this point.
Absolutely.
Right? At least 18 months ago.
Yep.
And we were underwriting on a completely different set of criteria.
We never could have foreseen we'd be right here right now.
I don't think so. I mean, I think probably a year ago I saw an article that the Fed was going to try and get to, was the target inflation rate was 2%, and based on math, it meant that agency debt would go to 6.25 and 6.5. And I kind of laughed at it. I'm like, whatever. Sure enough, right? Last quote we got was for 6.25%.
Well, we did, and how many times have we heard, and we continue to do this? I don't mean to interrupt. We'll jump right back in, but just we have a really, really confident way of predicting the future because we don't really hold ourselves accountable to those predictions. Like how many times a year ago we're like, yeah, but by the end of 2023, things will probably settle back down. And we predict is like, okay, based on what? Because rather this particular moment in time, I don't know that we see rates coming down this year at all. They might.
Yeah. They might. Not this year.
And exactly. And I think we got to start to be honest with ourselves around like, you've got to just really dial in your investment thesis and your conservative underwriting, but like don't make predictions about what rates are going to do in the stress test your stuff.
Right.
Stress test your stuff and don't go on the I'll probably get back down by then because we don't know.
Right.
We just don't.
Right. I mean, I think there were pockets across the country where you can have these very, very high end developments and name your price. Right, but there are very few and far between. I was talking to a developer in South Beach the other day.
I was going to say
and
Miami.
And they're building like some gorgeous stuff, right? With high-end retail on the first floor and super bougie apartments up. But there is a very small percentage of the market that they're targeting, and there's people there that can afford it.
Yes, that particular tenant base is less. It seems to be less affected by macroeconomic fluctuations
because they're the ones that own the businesses that work at them.
Yeah, right. And you get to a certain echelon of wealth where you don't have as much on the line,
right?
You know. So I think that there's always going to be a product there.
This is like the third time we've said it, right? There's riches in the niches. Thank you, Jake. Yeah. And if your niche is the $4,000 or $5,000 a month unit, and you know how to target those people and attract them to your unit, you'll stay occupied, right? Maybe you don't need to run high incentives because they kind of see through that. Yeah. But if you jack the rent up $500 or $1,000 after a year, they're also like,
yeah, I mean,
I go out to dinner one less time.
Yeah, and there's only so many of those. There's only so many comparables. How many other places they're going to go?
Exactly.
It's a niche, right?
Exactly.
I always do that. Let's go move to Miami and start building.
I keep telling you,
$10,000 a month units.
I'm into it.
I love it.
I volunteer to go there on the weekends. I promise.
Deal.
I might not even expense all my expenses.
Yeah.
Take some on the chin.
There you go. Exactly.
But so look, I think that for just kind of, at least for me, closing the loop on this, I have mostly Class C in my portfolio, some Class B. The Class C and Class B, we are well ahead of projections.
Yes.
So we have a deal that we're coming up on days of completion of year 2. Our in-place rents are at year 5.
Wow.
Okay. Like almost the same for another asset that we're coming up on 2 years in at the end of November, and so on and so forth. So rents for B and C, I can say with confidence in the areas where we invest have not gone down at all. We've seen a little bit of tapering in the last 3 or 6 months, but when you're 3 years ahead of your business plan, it's okay.
Yeah.
And this goes back to conservative underwriting, right? So we underwrote very conservative on rent growth. We got there.
Yeah.
But the caveat is that property taxes and insurance got more expensive. But hey, guess what? When you're 3 years ahead of your rent growth projections, you can offset a lot of that, if not all of it, if you're managing all the other aspects of your business correctly. So everything that we do, every deal that we look at is a combination of levers. If we can grow here, can we offset here? If this goes correct, Are we going to be okay here, etc.? And it's, you got to look at that with a very good sense of safety. So we underwrote a deal just the other day, and I think we ultimately lost it, but we were very conservative on rent growth, expenses, accounting, so on and so forth. And it's just based on the benchmarks that we typically use.
Yeah.
The different markets really aren't that much different, right? And when you have seen a number of deals like we have, you just know the expense profile and you plug that in, and you get close.
Yep.
Right? But my point here is the BNCs have done very well. We haven't seen any sort of huge vacancy or delinquency issues, knock on wood. Right? There's always a handful, but we've been successful in rotating them out quickly. Thank you, Texas, for being a landlord-friendly state in this economy. And that's where I continue to make bets.
I agree, man. And I think that you made such a good point a little while ago, and I think this just goes back to, the common sense investment strategy. If you can just boil whatever your investment strategy down is into the most common sense way of thinking, then I think more often than not you're going to win more than you lose.
Yep.
And I think you also see those patterns play out if you just start to look in retrospect, right? Like, I don't believe it is by coincidence that so much Class A high-end stuff is hitting the ground now. That was probably conceptualized and underwritten in a 3% rate environment where money was basically free, and we were in this pandemic era economic crazy like bizarro boom, and it just felt like
it was never going to end.
It felt like it was never going to end, man. It felt like COVID was the thing to overcome. We figured that out. And everybody was still employed and making money, and interest rates were low. And we were like, and plenty of investors were probably like, their common sense methodology was cheap money, people have got money in the bank, employment's good, the pandemic didn't make the world end, let's go build high-end stuff. And then a few years later, though, the one thing you don't account for is it takes a while to build these things.
Yeah.
And who knows what the other side of the coin holds if, for example, interest rates increase at the fastest pace in human history,
right,
and inflation goes to 8% and all that type of stuff. That doesn't mean that wasn't a quality line of thinking. I don't think that anybody predicted what the last 18 months were going to hold or 12 months were going to hold. But I see that line of thinking. And so now you've got to position yourself right now to go, this macroeconomic environment, what is the most common sense strategy for me to go forward with, right? And that can be, it can mean different things to many people, but I do think that your best line of thinking is always just, what is the problem that I can solve for people right now? And in this environment, it is normally, what is the nicest product that I can offer for the most affordable rate? And if you're doing that as an investor, you're probably winning 90% of the time, no doubt right now.
Right. I think the other piece of this that we haven't really talked about specifically in the B and C class markets, or let's just say non-new markets, is I think property performance and tenant retention, super important.
Yeah.
Right? Like we've seen almost a night and day difference in the course of the last 6 weeks at one of our deals where we got a new regional in, right, to run the property. Super responsive, very cordial, very attentive. She's doing a lot of the tours in person herself. Her close rates through the roof. And I think today, when there are more options for tenants, you've got to win with service, right, across the board. The tenant experience is so much more important today than ever because of the amount of supply, the amount of options, but also the speed at which information flows. You get one pissed off tenant or one pissed off prospect that puts a bad Google review out there about you. It's hard to overcome that.
It's hard to overcome. I mean, because there's options, right? And there's just a lot of options for tenants to choose from right now. And that again is, when everything is uptrending, it's you can see it. I've seen a lot of Class A properties. I've lived a lot of Class A properties in boom times when, the tenant experience tends to become a B priority.
Yeah.
It feels like, right? You're able to push rents every year. And if you don't want it, somebody else will take it, and I do believe, especially as an operator, that people need to hear that right now, right? Like, you are operating a business, not just an asset, right? Property management is really the management of the property. Asset management is the management of the entire operation, which includes property management. And one of the key pieces in that right now is your customer experience.
That's right.
And that is an intangible because it's hard to measure, but you can certainly measure your renewal rates.
Yeah, absolutely.
You know what I mean? And your occupancy rates. And I think that that's key. So if you're an operator or investor listening to this, you know, I would do some auditing of what you can do to make sure that you're giving a first-class experience, even on a B or C class property.
Yep. As an investor too, I want to give a little advice, especially in new construction, right? Inflation is not just interest rates, right? So when you're talking to a GP or a sponsor of a deal and they're bringing you a new build product, you've got to ask questions like, how is our contractor obligated to deliver at these prices? Right? And how have they guaranteed that to us throughout the life of this project? Because look, their expenses go up too, just like the gallon of milk and the steak that we buy and all the stuff at the supermarket. And their insurance goes up too. And if you don't have a contract with them that lives through the life cycle of that build project, and their expenses go up, they're going to pass that on to you. Right? And that could further weaken your returns or create, you know, some distress in the deal. The other thing is that watch out for the great deal. I know the guy and he's going to give us a great deal on the build. What if that guy gets hit by a bust?
Yeah, or what if his business just changes? He can't give you that great deal anymore.
Right. I mean, how are you going to complete that project? You're going to do a capital call because you can't find a GC that can deliver at those prices? So just be careful about the once in a lifetime, or you know, the thing that's almost too good to be true.
Yeah, I mean, we're looking at a development deal right now, and that's one of the biggest, you know, points of focus for us is, you know, this is an 18-month project. How do we make sure that we get through the entire thing, and our you know, construction manager and our GC they're accountable to the quotes they're giving us.
Not just accountable to the quotes, but what's the backup plan? Right?
Yeah, what if it doesn't work?
Life gets in the way, right? Sometimes, like, what if our GC, you know, has a personal issue and they have to take 6 months off, or has a family issue and they need to go back to some remote part of the world to take care of a sick relative. Then what, right? And these are things you got to think about. Right? Is there a chance it could happen? Yes. Is it slim? Yes. But I don't want to make a tough call to my investors because I at least didn't ask and didn't have an idea of a backup plan.
Well, that's the thing. It's a slim chance, but you only need to blow up a couple deals to take the whole thing down.
Exactly.
Your whole investment portfolio, your whole career.
That's right.
You know, and
I think Sam talked about that too, right? Reputation management. Right? Ask tough questions, shoot at it, right? And eventually your gut's going to tell you whether or not you should be pursuing it or not.
150%. 150%. Whew. Man. This feels good. This is a fun little kick around. I'm excited about the future, though, I will say, because I think that right now, more than anything, you know, it's a tough environment to navigate, but I do think that there is some really common sense problems to solve out there for investors. And, you know, if you can underwrite well, and if you can also not talk yourself out of good deals, you're going to have opportunity. You know, I think that's super
it's very difficult in this environment. Look, money makes people get emotional. And as much as you try and take the logical and analytical approach to things, sometimes emotions get in the way, right? And, you know, I think right now, just about every deal that I've underwritten, talked to a broker about, talked to a seller about, there is some kind of flexibility. People are looking for, yes, they're always looking for price, but they're looking for a surety of close, and they're looking for people that have executed deals in this market, right? And we check all of those boxes, right? And if we put our story in front of a seller quickly and say, listen, we took a look at your deal, we asked you a bunch of questions, we've done our due diligence, you want X, and we can get to Y, and I know it's not X, but here's why we think our option is best. You're gonna start a conversation. Will you win all those? No, but you got to get to the conversation.
You know, it's so funny is I was just thinking about, a very similar line of thinking yesterday. And this just goes back to the kind of the common sense thing, right? Contrarian investing, when everybody says it's a good time to do something, it's probably not as good a time as you think it is, right? And when everybody says it's a bad time to do something, it's probably not as bad as you think it is. And also the way that information reverberates around creates, stubbornness or flexibility on either side. So, for example, Grant Cardone had said something yesterday that I was reading about how, it's just not a great time to invest in this environment right now. And I'm sitting here thinking like, why would he say that?
He's creating fear, so people call him up.
A guy who's got that much influence,
exactly.
Right? Is he creating his own flexibility because he basically can move markets?
Move markets, exactly.
Right? So Grant Cardone comes out and says it's a difficult time to invest, don't do it. And now he's talking to somebody who's about to submit an LOI for or whatever, and he's created his own flexibility there.
I would not be surprised if the exact thing you just described is what happened.
Why wouldn't it
right?
be? And so that's the kind of common sense thing I'm thinking through. Is like, you don't always, sometimes the masses are right, but you don't always want to go, okay, the most influential people are saying it's a bad time to invest. Let's just listen to them. You got to think for one layer deeper and go, well, if I was trying to create my own flexibility on the seller side, I would, and I had influence, I'd probably be trying to make as much negative, information as I could. And sellers know that stuff. Brokers know that stuff. If it feels like the environment is a little murky, don't be afraid to have conversations because, like you said, you'll realize that everybody feels that way, so there's probably flexibility. Don't do dumb deals. But the opposite is also true. When everybody thinks it's a great time to invest and you're competing against 15 other parties for every deal, you got to remember, you're making a decision now that you're going to have to exit this thing in 5 years potentially on. Is it going to be the same environment forever? Right. So I think that contrarian strategy mixed with some common sense can usually do wonders for you.
I agree. I agree with everything that you said, but I think there's a paradigm shift that is really where wealth is made. And it's this concept that I said a few weeks ago, buy on mystery, sell on history, right? The speed of information right now has immediate impact on markets. And kind of thinking about a stock market analogy, you want to own a stock before Goldman Sachs puts a buy rating on it or a strong buy rating on it, right? Yes. When they increase that price target based on some company's performance, you probably have some upside left, but you probably don't want to buy it the day they made the recommendation, right? So when there's a really strong market, when there's a lot of demand for multifamily assets, you want to be a selective buyer, but you probably want to be a seller.
Yeah.
Right? You most definitely want to be a seller because there's going to be 15 people looking at your deal, and that drives up demand. Sure. It drives up price, excuse me.
It does. I mean, even right now, after the last 12 months and in the way that rates have been and all this type of stuff, I would still love to be somebody, who had the majority of my acquisitions between 2017 and 2019, and going through
Completely
the entire,
agree.
So I couldn't agree more, man. It's actually good to be a seller right now if demand remains where it's been.
Yep. So we're coming up on 2 years on a project, and we just had an appraisal done to renew our financing facility at the same rate that we got 2 years ago, which is excellent, thank goodness. But all indications say that the valuation is going to be exactly where we needed it to be. Yeah, which is awesome. So hopefully the valuations don't change much. But I'm really excited to hear about property tax grievances coming down to less stratospheric
sounds good.
Yeah, stratospheric levels. And then I think we got a little bit more property tax relief on the way. Insurance doesn't seem to be quite the buzzword that it was.
I don't think it's increasing at the same trajectory. Let's hope.
Yeah, I agree. And then with inflation back down to 4.1%, right? The last report was 4.1.
Yeah. I
think operational expenses kind of come in check. So hopefully we get a little bit more stability. Market returns to some normalcy. We've been seeing some good deal flow. And It's time to strike.
It's time to go execute. 100%.
I'm ready.
It's time to go execute on making sure that you like, share, and subscribe to the More Doors podcast on Spotify, Apple Podcasts, wherever you get your podcast content. Make sure you go check out deepbluere.com. Join our community. Join our mailing list. Check out our upcoming opportunities and all of our educational value pieces, and just network with us. We'd love to connect with you, understand more about your investment goals and strategies, and how we can help you build that type of legacy wealth. Make sure you check out torestudios.com, T-O-R-E studios.com, for all your content production needs. If you want to shoot your own show or work on your own video type of multimedia projects, check out torestudios.com. This has been episode 10. We'll be back next week. Thanks, brother.
Yeah, man. Good stuff. Lots of fun.
Great stuff. All right, we're trying to buy FC Dallas tickets. We got to get out of here. Thanks, guys. Bye.